Investors, though, continue to sell shares of Blue Owl. What's the latest? What's the latest update?
Well, we're still seeing the stock down, obviously. The bonds are under pressure. I mean, I think the two big questions now are, one, how much stress is in their portfolio? We know that they were very active in the software lending, and that sector obviously is under a lot of pressure again today. But not just Blue Owl, but the whole private credit business had a lot of exposure to technology and software. Those loans are coming due. They all need to be rolled over. What happens next? The other big question, I would say, is what does this do to the big retail push for private credit, which has gone from 0 to 1.8 trillion very, very quickly. The retail push is founded on this belief that you could get to 40 trillion fairly soon in private credit. If retail gets rattled and backs out, that whole $40 trillion dream falls apart.
And tell us about what makes Blue Owl specifically unique, because they have vehicles that retail has been able to access for quite some time now, even before the White House is trying to get retail into private assets. So what about Blue Owl makes it so that we're talking specifically about this firm right now instead of other alternative asset managers?
I mean, I think the whole sector's under pressure. Blue Owl has BDCs just like the other ones do, and this is the fund we're talking about. It's a business development company, a very, on the face of it, boring fund that just makes very straightforward loans to companies, often middle market companies that and they're in the high street. So, Blue Owl has become kind of the whipping boy for private credit, possibly because of their bigger exposure to software, which everyone is very worried about with the move to AI.
But this gets to, there's not a lot of transparency about all the investments. I assume that if you are an investor in one of these funds, you have an idea of what is in these funds. But is that a wrong assumption? Well,
if you're a lender directly, you get a lot of information. And then if the group gets slightly bigger, then those new lenders get more information. But if you're joining late or if you're way down the stack, you probably don't get a lot of information, not much transparency. You certainly don't get very many updates on the price. And as we've seen with BDCs across the board, they all have the same loan. Some of them are marking them at 95 and some of them are 70.
I want to ask you about something. Bank of America is out and says a significant level of misinformation, that's their word, that caused a rout in Blue Owl Capital shares presents an attractive buying opportunity in the stock and some peers, according to BofA Securities. Here's what they say. Misinformation stems from a lack of understanding of what private credit is. So we constantly here at Bloomberg remind everybody about private credit is kind of a different beast. And it's not as liquid as some other things. You invest for a while. But what are they getting into? I mean, what is the lack of understanding when it comes to private credit that maybe investors don't get? Is it that your money gets locked up? But this sounds like it's something more than that.
Well, the word private, I think, worries people. What you don't know can harm you. There's a fear of, the unknown, basically. And I don't think the private credit people, we went through this golden age a couple of years ago. Now we're hitting the wall of the maturities. I don't think they've done a particularly good job of explaining the stress, which we're seeing rising in terms of payment in kind, in terms of non-accruals on the BDC side. So there's certainly distress. We are hearing loans trade or new lenders coming in and offering much lower levels for loans that are coming up for maturity. So, they're under a lot of stress. But it's hard to be transparent when you are actually private.
You've covered credit for a long time. I'm wondering what your take is on why credit spreads in public investment grade and public high yield are so calm if we're seeing the BDC performance showing a lot of investor jitters about credit and lending.
Part of that is when we talk to high yield managers who've been doing this a long time, they talk about private credit as a cleansing device for their market. And so, what they'll tell you is that the private market is taking the stuff that they don't want, so the bad loans, and that has a beneficial effect. And so therefore, high yield and leveraged loans should be safer, they should be higher quality, therefore spreads should be tighter.
James, I think about this all the time because you talk to somebody in the private credit space and they say, we're top of the tier in terms of what we're investing. Like, we know we're doing all the due diligence for our investors. And to some extent, you have to think that those funds are not going to continue to attract new money if they're not providing the returns. So maybe there is a checks and balances, but the more I hear that, the more I'm like, it can't all be top tier.
Well, we've had that conversation for, I would say, the last 3 years with all of the new private credit people and all of the existing private credit people. And one of them actually made the comment that, yes, there are bad deals being done, but it's not them, it's the, quote, tourists.
In just the last minute.
Are they right, though?
We'll find out.
Or we don't know yet.
We'll find out.
That's what this is all about.
There's a lack of transparency that's leading to fear of the unknown, and it's feeding on itself at this point.
And yet we have, rightly so, the founders of Blue Owl defending themselves. Co-CEO Mark Lipschultz said, performance has been strong, loss is minimal, investors are ignoring facts and acting out of fear. Where are the investors not seeing eye to eye with the founders? Why such a big difference, I guess? I
think also retail was kind of led to believe that they might have more liquidity than they actually do. And that's the whole point about the push to, let's say, 401ks and everything else in retail, that you do kind of expect a bit more transparency, a bit more liquidity. And then when you suddenly realize that you don't have it, then you start to panic.
But to that point, I mean, maybe investors don't understand that, right? You're locking up your money, but permanently shutting the gates of one of your funds, that's not what the goal is, right? Like, that's not ideal.
It's not. It's certainly surprised a few people.
Okay.